So I'm going to talk about an income statement and what it contains. An income statement is something very important to the financial aspect of a business and depicts the company's financial performance during a specific period of time. The first section of the income statement is the revenue. Revenues include revenues as well as sales. Sales represent the direct sales to the public, while revenues represent the income from non-direct sources. In regards to McDonald's, sales would be a cheeseburger sold to a customer and fees from franchises. The second section is the operating costs and expenses. This section deals with most costs and expenses associated with the company with several different categories. Cost of sales represents the expenses incurred by McDonald's to produce the product. An example of this would be the cost of McDonald's food, labor, and utilities. This is represented here by the company-operated restaurant expenses, as well as the franchise restaurant's occupancy expenses. Selling, general, and administrative expenses relate to the management of the overall company. This includes management, advertising, marketing, and license expenses. Depreciation represents the expensing of asset costs over a prolonged period of time. If McDonald's buys a structure to house a company-owned restaurant, the cost is first capitalized and then expensed over a period of time. Amortization is similar to depreciation, except that it is related to the expensing of intangible items over a period of time. Intangible assets include trademarks and licenses. Next, we have the operating income. This is calculated when we have the total revenues of $21,586 and deduct the total operating costs and expenses of $17,141, which gives us the amount of $4,445 for the operating income. Usually this section is often used by investors as a measure of profitability or of how well the business is doing in making profits for the operation. Additionally, the income statement also has the interest section. Over time, this section is the net number of both interest income and interest expense. Interest income, for example, can be interest earned from invested funds, from bank CDs, or money market funds. On the other hand, interest expense is accumulated from loans and bonds from banks, bondholders, and the like. Non-operating income represents a total of all other non-operating revenues and loss that arises from dividend income or profits and losses from investments and any source of income or loss derived outside of the company's main operations. As for the provision for income taxes, it is a calculation of an estimated amount that needs to be paid based on the GAAP. However, this amount does not represent the amount due to the federal or state for year-end corporate tax returns. We then have income from continuing operations and income from discontinued operations. The latter is when the company stopped a line of business or sections of the business that were not profitable and then sold it. It is often classified separately from income from continuing operations as to not confuse investors and set a clear picture for what the actual profitability from the main operations are. With all the above numbers, we can come up with a net income of $3,544. Within the income statement, the bottom portion is always reserved for the EPS calculation or the earning per share. The net income per share is calculated from the net continuing operations and discontinued operations. Hence, our EPS is $2.83. The income statement is one of the 4 basic financial statements used in accounting. Most of these numbers are taken from the balance sheet, which is the first financial statement. The statement of retained earnings and then the statement of cash flows follow the income statement. I hope you found this information helpful.